Friday morning, the 14th of September 2007. Outside a bank branch in Kingston upon Thames, a queue is forming. Then another in Newcastle, Sheffield, Glasgow. By mid-morning, they stretch around corners, pensioners with folding chairs, couples with paperwork in carrier bags, people who have taken the day off work to stand on a pavement. They are not waiting for a sale. They are waiting to take their money out of their bank. All of it. The bank's website has crashed. Its phone lines are jammed. And inside the branches, staff who found out from the evening news, same as everyone else, are counting out life savings in cash. Nothing like this has happened in Britain for over 140 years. The last time depositors ran on a British bank, Queen Victoria was on the throne. The bank is called Northern Rock. In 5 months, it will belong to the government. This is the story of how it died. Gone under. How British business dies. Northern Rock was never supposed to be exciting. It was a building society, born in Newcastle in 1965 from 2 Victorian institutions, owned by its own savers, lending carefully to people in the North East who wanted to own their homes. Then, in 1997, it floated on the stock market, and it stopped being careful. The new Northern Rock had a simple idea: grow faster than everyone else. By the mid-2000s, it was one of Britain's 5 biggest mortgage lenders, writing home loans at a pace the old building society could never have imagined. Its flagship product said everything about the new philosophy. It was called Together, a mortgage of up to 125% of the value of the home. Borrow more than the house is worth, on the assumption that prices only ever rise. In 2006, the bank made £443 million in profit. Its name was on the shirts of Newcastle United. 6,000 people worked in its offices, in a region where jobs like that did not come easily. In Newcastle, Northern Rock wasn't just a bank, it was the pride of the city. But the growth was built on a mechanism, and the mechanism had a flaw. A traditional bank lends out its savers deposits. Northern Rock had far more loans than savers, so around 3/4 of its funding came from somewhere else. The international money markets, borrow short-term from global investors, bundle the mortgages into securities, sell them on, repeat. Faster and cheaper than waiting for deposits. As long as the market stayed open, it was brilliant. Nobody asked what would happen if they closed. They closed on the 9th of August 2007. The trouble started an ocean away in American subprime mortgages, loans to borrowers who could not repay them, bundled into the same kinds of securities Northern Rock sold. When those started failing, investors stopped trusting all of them. In a single day, the global market for short-term bank funding froze. Northern Rock held no meaningful amount of American subprime debt. It didn't matter. The bank had built itself a machine that needed to refinance billions of pounds constantly, forever, and the fuel supply had just been cut. Through August and early September, the bank searched for money that no longer existed. A £5 billion bundle of mortgages was due to be sold to investors in mid-September. There were no buyers. There was now only one lender left who would take Northern Rock's call, the Bank of England. On the evening of Thursday, the 13th of September at 8:30, the BBC broke the story. Northern Rock had asked the Bank of England for emergency support. The rescue was meant to be reassurance. The public heard something simpler. The bank is in trouble. At the time, British deposit insurance protected the first £2,000 in full, and only 90% of anything above it. For anyone with real savings in Northern Rock, waiting in a queue was not panic. It was arithmetic. By Friday morning, the run had begun. The first on a British bank since 1866. Within days, £4.6 billion walked out of the doors. And on that Friday, as the queues grew, the chief executive, a Newcastle man named Adam Applegarth, who had driven the bank's dash for growth, went on television and offered the nation his assessment. The queues did not go home. The share price fell by a third in a day. On Monday, savers were still withdrawing millions an hour. It took the Chancellor, Alistair Darling, standing in front of cameras on the 17th of September and guaranteeing every deposit in the bank, every pound backed by the state, to finally stop the run. The government of the United Kingdom had just co-signed for a private company's promises. By the end of December, Northern Rock owed the Bank of England £28.5 billion. So who paid for the fall of Northern Rock? Adam Applegarth resigned that winter. He left with a reported payoff of £760,000 and a pension pot reported at £2.6 million. He was 45. Newspaper analysis, a decade later, put his retirement income at over £300,000 a year. The shareholders, including thousands of ordinary savers who'd been given shares when the building society floated, were wiped out. When the government nationalised the bank in February 2008, their shares were valued at nothing. The employees paid. Thousands of jobs in the North East went in the years that followed, and the borrowers paid longest of all. The people holding those 125%, together mortgages went into the crash owing more than their homes were worth. Press analysis of the bank's own reports counted more than 40,000 repossessions in the decade after the collapse, around 12 families losing their homes every day. In 2012, the cleaned-up remains of Northern Rock were sold to Virgin Money for £747 million, a fraction of what the state had poured in. The toxic half stayed with the taxpayer for years longer. No one was prosecuted. The regulator admitted its supervision had failed. A parliamentary inquiry found the bank's directors had failed to protect it from the risks of their own strategy. The strategy's author retired to Northumberland. Northern Rock did not die of bad luck. It died of a bet that the money markets would stay open forever, made by executives who collected the winnings in salary and bonuses while the bet was still live, and handed the losses to everyone else when it failed. The savers got their money back because the state stepped in. The people who built the machine kept theirs because no rule said otherwise. That is the pattern in these stories, and you will see it again on this channel. When a British institution fails, the bill and the blame almost never land in the same place. Because the queues outside Northern Rock were only the beginning. Within a year, the British state would be rescuing banks 100 times more dangerous. And one company you'll meet soon didn't just gamble with mortgages. It built Britain's hospitals, schools and railways, and collapsed owing £7 billion, with just £29 million in the bank. That story, The Fall of Carillion, is next. If you want it, subscribe. New film every Sunday. Gone Under: How British Business Dies.